What's up, guys? I hope you're doing well. Actually, one sec, sorry. I forgot to turn off the fan because I know sometimes there's some background noise in there. Um, Anyways, I want to go over the repo market and a recent post that I just did. Just kind of going over just the basics from my understanding and what I've been finding. And I put a few citations in for this one, I think like five, which for a blog post, unless you're doing a very extensive one, um, seems like a lot. But, anyways, so basically, all the repo market is a short-term lending market involved in the trading of various types of securities, and this is literally done to trillions of dollars a day. A lot of the times, the maturities are literally overnight, and we'll get into that in a second with graphs and stuff too. Um, so again, the whole purpose of this is to provide short-term liquidity for mostly fixed income markets, considering that all the securities, or at least most of the securities, are some type of fixed income, whether that be government treasuries, government entities, corporate bonds, whatever. Um, so yeah. And a good way to think about them is as collateralized loans, and they are treated as such for like accounting and I think tax purposes as well. But they're technically not loans, really. They're called repo is short for repurchase agreement, right? And so it's literally like you have one entity selling whatever security to another one, and then with the promise of them being sold that back at a higher price, right? um and naturally the Fed also participates in this market, one as a way to conduct monetary policy, but they can also influence the supply of different types of securities as well, through this. And just kind of going into a general schematic of how it works, you have two general types, which is bilateral, which is basically you have your cash investors who bring the cash initially, and then you have the collateral provider or whoever you want to think of it as. Basically, you have the cash provider, they provide cash, and they do all of this through security dealer. This is for bilateral repo. And then the cash goes to your collateral provider, um, which then in return gives them the securities to the other side, right? And so the whole point is the cash investor purchases the security from the collateral provider, right? And so this, as you can probably see from in here, this could be hedge funds, it could be asset managers, it could be money market funds, it could be stuff like that. Right. And so you have cash moving from, say, I like to think about it in terms of like, say you have like a hedge fund or a money market fund or whatever, and then a commercial bank. Because a lot of the times I'm doing my thinking of this through the lens of like the Fed, where the Fed is a counterparty. Um, that's how I really got into it. And so basically, that's just an easy way for me to think about it. So you have, to use that example, you have hedge fund buys treasury from commercial bank. Um, right? And that's the opening of the transaction. And so to cash goes from hedge fund to commercial bank. Security goes from commercial bank to hedge fund, right? And at the end of that, and then to close out that transaction, you have the the commercial bank repurchases that security from the hedge fund, so at a higher price. And that's why you can kind of think of them as collateralized loans, because there's an interest paid. And we'll go a little more in depth into what exactly that means in a second. There's also tri-party repo, which you have the same general thing happening, but it's all done with a clearing bank. Um, Basically, this transaction happens on the balance on the with the accounts at the clearing bank. So it's not like it's everything's being transacted and settled on the accounts of the clearing bank, just between the two entities instead of having to go through a dealer and back and forth. And there's a little bit difference in regulations and stuff like that. Um, that I didn't go too far in depth. I did find a nice piece about more of this in depth, which I did cite, and I should have a link at the bottom of this to it. But it's also this SIFMA article um, that you can look up. I got it from this source. It's rather lengthy. So even if you just look up source Federal Reserve Bank of New York, SIFMA, um, you should be able to find it. It's very easy to find. I think when I try to look up the difference between these, or well, to get a graph, it was like the first one to pop up. Okay, so there's that, and then the actual transaction itself. So it's like I said, it's a lot like the a collateralized loan. You have principal, there's the interest, the type of security uses collateral, maturity, and then one thing that is new is the haircut for the repo transaction, right? And so, just like a loan, principal, it's the same thing. It's the principal. And then interest is different for repo. So, basically, because it's technically not a loan, it's a repurchase agreement. And so, basically, before the transaction is open, to my understanding, um, uh, basically the interest is auctioned, right? But it's not an interest rate. Basically, they're auctioning the highest price that repurchase will do, right? And so basically, when it's opened, that we went over a little bit before, whenever the transaction is open, the transfer of cash from the cash investor to collateral provider, right? Um, that happens, and what they're auctioning for is the that repurchase price when the collateral provider repurchases the security from the cash investor, right? And so that's what they're auctioning, and that's what they're bidding and stuff for. And so the difference between the repurchase price, the higher price that was paid the second time, and the sales price, that is the interest for the transaction. Um, in terms of types of collateral, this is another chart from the Federal Reserve Bank of New York. This is in billions of dollars. For some reason, whenever I try to get this over here, it wouldn't put the axis on there. So, or well, the label, I guess. But anyways, as you can see, most of the repo transactions, and this is specifically only for tri-party repo, which is, I believe, 80% off the top of my head of the overall repo market. Um, so there's that. And this is the composition for the different types of collateral. So you have the treasuries and then agency MBSs, right? So mortgage backed securities, and all agency means is it's uh, a government entity. So in the case of agency MBSs, this is your Freddie Mae, Fannie Mac, and then Ginnie Mac as well, which is slightly different than the other two. And then you have agency, which is like other government agencies, corporate bonds, equities, and then there's other. Um, but most of them are U.S. Treasuries and then the mortgage-backed securities. Um, yeah, so the tri-party repos are about 80% of the overall repo market, which means that these agency MBSs and the treasuries are the majority of the market. Um, okay, so how is like the maturities of the transactions dealt with, right? And so this is just whenever that closing end is going to happen, because that is agreed upon before the transaction is initiated, right? Because you don't want to just initiate a transaction, excuse me, and not know when you're going to get paid back, right? Or whenever it's going to end. And so basically, this is settled beforehand, and a lot of the times it's overnight. And I kind of say that because here we have the daily traded volumes, and we have all repo transact or all tri-party repo, and then overnight repo. Um, and if you've noticed, I've only really the graphs and stuff are only for tri-party repo. There's a reason for that, and I read a little bit about it in that article I alluded to before, the SIFMA one, where basically the Fed even acknowledges that they don't know a lot of what's happening in the background. And so basically they only have data on, not only have data, but they have the most data they have on the repo market is for tri-party repos or trilateral repos or whatever you want to call it. Um, the other types, and there's a few other types that we're not going to get into in this one specifically, um, are they don't have as much data about, um, according to the article I read and stuff, and it's in here as well. And basically, that was done. That was, I forget which number it was, but it was one of the Federal Reserve staff reports for the New York Fed. So I'd say they at least know a little bit about what the Fed knows. But anyways, back on the maturity dates. So basically, if you notice, this gray line is all tri-party repo transactions, and this black line is overnight repo transactions. And this is due to the left axis, right? Not this. This is the interest rate on these, um, or the implied interest rate, whatever you want to call it. So this left one, we can see, this is in billions as well. And so this is right here, this 1,000. So 1,000 billion is a trillion. And so we can see that it's over $1 trillion, only for tri-party repo. The absolute total is quoted somewhere between 2 and 4 billion between different sources. But it's also like, because a lot of the times they don't differentiate between repos and reverse repos. They, there's a lot of double counting in some of the numbers. And so that's part of the things that they're proposing to try to fix in that one article I keep alluding to. Um, you know what? Since I keep alluding to that, I'm going to try to do in like a actual post and try to go through that one more in depth too, because it was very helpful in helping me really kind of understand what's going on, at least to a much greater extent than I did before. So it was very helpful. But anyways, also keep in mind that even with these, the volume for all tri-party repos, um, this is still a short-term lending market. So this just means that the maturity is literally not overnight. It could be 2 days. I think I've seen some of the longest ones go to 2 weeks, um, at least quoted directly. But the majority of them are overnight. This is a short-term funding market, so there's that. But however, they don't technically have to have maturity dates. It's just most of them do. There is such a thing as open repo agreements, also known as on-demand repos, where there is no maturity dates. Um, and so basically, once you open the repo, um, it's ended when either party gives notice by the daily deadline. Because again, this is overnight, and so I think depending on the type of repo, there's like a schedule, I think, if I remember correctly, that starts at like 11 a.m. or something, and then you have to, like, tri-party repos or whatever have to be settled, or at least like give notice or whatever, um, by 11 a.m. that next day, before it to settle before the end of the night or something. Again, I'll go more in depth on that and obviously research it more, in future posts. But yeah, if it's not terminated, then the agreement just rolls over every day, and interest is paid monthly, and periodically they reprice stuff. So the haircuts is what's really different for repo transactions. And so basically, as you can imagine, with having these types of transactions, on an overnight basis, and this is obviously not a small market. Trillions of dollars every night is kind of a big deal, so to speak. And so that's a lot of risk. And you can imagine with such, basically, there's a very significant amount of counterparty risk, or at least I would think so, simply because you're trading literally, like, each transaction can be billions of dollars, and it needs to be paid back overnight. And so that's kind of a big deal, it seems. And so basically, what the haircuts mean is the cash investors, um, want a significant over collateralization, right? And so if you're wanting, say, like $1 billion for principal, instead of having just $1 billion of collateral, you'll have 1.1 billion. in collateral for that transaction. And so you're essentially all the haircut is discounting discounting the collateral so that you can kind of fit more in there for the same price, right? And so that's what it's the discount from the actual market value of this of those securities that are being used as collateral. And so it's like you're taking a haircut off of it. Um, so yeah, there's that. And so now like how more of like how the Federal Reserve is involved. Um, so this is where the Fed uses the reverse repo rate or your on RRP rate. And basically they use this as a floor for Fed funds for entities that cannot hold bank reserves, right? So like things like commercial banks and stuff, they have accounts at the Fed and they can just use bank reserves and stuff like that. But however, if like money market funds and stuff like that who don't own or who do not have bank reserves, or they don't have accounts at the Federal Reserve, um, they can't use like the interest on reserve balances or those kind of things. So instead, basically, they have the repo market where they do repo transactions with the Fed as a counterparty, and they can do it that way. And so basically, and again, this is the Fed. If you notice, it's the reverse repo rate, and that's simply because the difference between repo and reverse repo, it's the same transaction idea. It's just from the other point of view, like it's switched. Um, and so the thing that's interesting about this is I always pay attention to, or the way for me to understand it, at least on closing for the transaction, is you have where's the interest going? So who's paying the higher price, right? And so for reverse repos, um, basically, the sorry, I want to make sure I get this right because sometimes it's very easy to switch. Um, basically, in the end, for reverse repos, the Federal Reserve is paying the higher price, and so basically no, I'm sorry, it's the other way around. So basically, for reverse repos, the Federal Reserve is buying the Treasury from the commercial bank or whatever the entity is, right? And then on closing, they the other entity, the commercial bank or whatever, is selling it back to the Fed at an interest rate. So on net balance, there's um, more money is the money supply is decreasing because more money is going to the Fed than that was leaving the Fed. And so on net balance, there is a net subtraction from the money supply, right? And so basically you have since that cash investor, whatever it may be, um, pays more for the repurchase of the security, that interest, right? Because they're paying more is going to the Fed, which is pulling more money the out of the system um, on closing of the transaction, right? And so that's one of the things that can be very interesting is like how this affects the money supply and kind of the idea behind that. And so, like in the past year or so, whenever reverse repos with the Fed as a counterparty have just like been increasing significantly, I think those themselves are upwards of $1 trillion now too. That's one of those you're essentially they're continuously pulling money out of the money supply, right? And so I don't know. For that specifically, I will have to. I'll do another post on that and go more in depth and basically just try to get some actual graphs and hopefully numbers itself and go over that as well. But anyways, and they do all of this with the FOMC has an overnight repo facility, and they do it all with that. But anyways, I think the repo market specifically, it's very important because this is like you're looking at like the plumbing of the global financial system, right? And so it's like you're dealing with a lot of money, obviously. Um, Not only that, but you're having to this is banks just trading trillions of dollars every day. And so if and they're doing that for liquidity reasons, right? Because they need the money. Or they need like because they're doing it for cash, or in other situations to where the focus is more on collateral, right? Because some of them are getting treasuries instead, to where they're parking their money at the Fed or whatever entity, whatever. And basically, and since it's a repurchase agreement, they own the treasury in the middle of that transaction, so they can do what they want with it. And so there's something called like rehypothecation, where they can do where they basically like leverage the treasury and then do a whole bunch of other stuff. And I haven't gone too far in depth with that specifically, but that's definitely in the pipeline to go over and try to learn. But anyways, this is what I found, and it can get confusing at first. And I'm not going to pretend that I'm an expert, obviously, but it's definitely interesting and worth going into. So, anyways, that's all I got for today. So I hope you guys have a good day, a good week, and I will see you on the next one.